As the AI rally was getting hot, I was mainly looking for stocks that had exposure to AI, but they were mainly outside of mainstream media, not talked about a lot on YouTube. And I was trying to share them with you guys on YouTube. One of them was Constellation Energy, and it has so far done extremely well, up 26% over the last months. But I believe AI in general is getting overheated, and I will likely no longer be sharing similar ideas. In fact, I'm mainly looking for stocks outside of AI, quality companies, sometimes cheap companies, like the second stock, which I'm gonna share today. It's an amazing company, quality company, wide moat, competitive advantage, 4.5% dividend, 14 times earnings, growing 8% in earnings per share. Maybe some of you have never heard of it, but I'm sure some of you will likely enjoy my analysis on the stock. And the first one is a stock that I talked about before, but I'm gonna talk about it again because I think it's presenting a good opportunity. And I believe both of those stocks have the potential to potentially go up if we do have a major pullback in AI. The non-AI stocks are going down right now because they're not too exciting. People don't like them too much. But once the narrative changes and the AI rally starts to cool off, I believe those stocks can potentially take off in a major way. But I also still believe they're amazing long-term investment if you don't really care too much about the short term. Now, the first one is Copart, ticker symbol CPRT. Copart is down 20% year to date. Copart owns a lot of the junkyards and auto auctions in the United States. They have a 45% market share, and another 45% is owned by IAA, which is their competitor. Now, the biggest differentiator between Copart and its competitor is that Copart actually owns their real estate. No one wants a junkyard in their backyard. No one wants those facilities near their homes or near their communities, and no one wants them. It's very hard to get the licensing for such facilities, and it's just very hard to rebuild them in general. So they have a real estate advantage. Their competitors, they lease the real estate. Copart owns their real estate, which is pretty amazing. Now, over the last 10 years, the company has faced some headwinds, you could say. One of them has been a lot of the technological innovation amongst cars. So cars have gotten much more modernized. There's a lot of bells and whistles in the cars nowadays. There's a lot of sensors, a lot of safety features. And as you guys know, Copart has a junkyard. So if your car is totaled and it's deemed that you cannot drive it anymore, or it's deemed beyond repair, it would be totaled. But a lot of those safety features, which are amazing features, they help people not get into fatal accidents. And the sentiment was that that would be extremely bad for Copart's business model. And even now, autonomous vehicles, people say that Waymos, they don't make as many fatal accidents, which means Copart's business model is dead. But this assessment is wrong, and it has been wrong over the last 10 years. And I believe it's going to be wrong over the next 10 years. And this is mainly because all those LiDAR sensors and all those, technological sensors and all those bells and whistles in those cars, they make the car so expensive to repair that those insurance companies are deeming cars non-repairable, and they're just totaling them because it's cheaper sometimes to total them to even repair them. They're so expensive to repair because of all those fancy sensors and because of all those technological stuff. They are just fancy in those cars. They're so expensive to repair. They make the car safer, but they make the car pretty much impossible to repair, which is why this has resulted in more vehicles entering the Copart auction. Approximately 1 in 5 cars are now totaled because of accidents, up from 1 in 10 decades ago. So despite all the safety features, 10 years ago, 1 out of 10 cars used to be totaled in the United States. Now it's 1 out of 5. Despite the cars being safer because of the sensors, but they make the car so expensive to repair that it's just better to just total it. And Copart is benefiting from the trend, and I believe the market is wrong again. But this is how Copart makes money. The first way they make money is from auction and transaction fees. So whenever the seller and buyers, they pay fees in the auction. Whenever they're buying and selling the car, they pay storage and handling fees, so yard storage to store the car, especially if there's a storm. Copart benefits from hurricanes, natural disasters, unfortunately, but there's a lot of damages to a lot of cars. all those cars will likely be totaled in a hurricane scenario or any kind of natural disaster. Again, unfortunately, and Copart has a lot of storage facilities for that stuff, transportation, export, and membership. So you have to pay a membership to be able to access and bid on the Copart cars. Title and documentation, other services like inspection, maintenance, and cleaning. The last quarter for Copart was actually not too bad. Revenues have increased 5.2%. Now, normally they increase 7, 8, 10%. This quarter was slower. This is because of their export business. So Copart doesn't only make money from the auctions in the United States. Sometimes they export cars that can actually be drivable, but outside the United States. So the cars themselves are actually good. But sometimes in the United States, there's high standards where the insurance companies, they say that you just cannot drive it anymore. They have to total it. But then Copart can export it to the Middle East or in other countries where they can actually drive those cars. So this export business has lower margins, but it has declined this year a little bit due to tariffs and due to other matters outside of Copart's control. And it has caused revenues to only increase 5.2%, but it has caused net income margin to expand, which has caused net earnings per share to increase 24.2%. This is massive growth for Copart. Now, if you look at the P/E ratio, it looks scary. It's trading at 26 times forward earnings, which might be very high. But you have to take into consideration that Copart has almost $5 of cash per share and no debt. The management is very conservative and they have a very clean balance sheet, $5 in cash and no debt. So you're not really paying $45 for Copart, you're paying $40. And if you adjust it on a PE basis, the PE is not 26 times, it's around 22 times, which is where the stock has bottomed back in October of 2022. So you could see the setup. The setup is pretty amazing. In terms of an amazing business, it's down 20% year to date. There's a lot of sentiment around the business being dead due to the Waymo and safety features, which makes the car more expensive to repair. So they just total the car. It's growing 22% in earnings per share. And the PE ratio is back to where it bottomed before. They have $4.90 in cash. They have no debt. As a company has a good track record of not doing dividends. They're also not big fans of buybacks. Sometimes they do buybacks, but it's not very often. Most of the times they do mergers and acquisitions, so they acquire other companies. But really, most of the time what they do is they like to widen their moat by purchasing real estate. So they purchase storage facilities, auction yards, other kind of real estate all around the world because they're expanding internationally, which is why their property, plant, and equipment has been expanding exponentially to $3.7 billion in prime real estate. Pretty amazing. Now, if you look at the net income margin of Copart, you're thinking about cars, auction, auction market, real estate. It has to be a low margin business, right? But if you look at Copart's net income margin, it's 29.5%. This is almost like a tech company, guys. I mean, Microsoft is at 33%, and you could buy Copart at 29.5%. This is, this is pretty impressive, and it has been expanding over time. Last 2 years, it has contracted, but over time, it has expanded, which is pretty amazing. Now, the average earnings per share growth is a little bit all over the place. Sometimes they grow 13%, like in 2025. 2026 is expected to be 6.5%. I believe that's too low. It will likely be higher. 2027 is expected to be 10.4%, and 2028 is expected to be 15%. But I believe Copart can grow on average around 12%. They have done it for the last 10 years. And I believe they will likely be able to do it for the next 10 years. So if we're counting 12% on average of earnings per share growth, a multiple expansion back to the mean from 22 times adjusted on the cash position back to 28 times, which is the mean, could potentially be higher. I mean, the stock was trading around 38 times a few months ago, and people were dying to buy Copart, and it was the best high quality company ever, and people were dying to buy it. Again, just like United Health before it went down. But when it goes down, no one likes it, and they start looking for reasons of why they shouldn't buy it and why the stock is going down, and they try to justify it. And then when it goes up, they say, "Oh, I should have bought some." That's normally how it works. Again, not financial advice, but that's normally how it works with such stocks. But I think the stock is looking very attractive. I see an average 12-13% annual return on Copart without a potential multiple expansion. And again, when the sentiment changes with Copart, the expansion could be quick and it could be crazy. It happened many times before, and it could potentially happen again. And you have a lot of margin of safety with no debt and $5 of share per cash, which is growing every quarter. And the company could potentially announce a buyback program, and they can put a floor on the stock or do acquisitions and other things. So I like Copart very much. Now, the second one, which is a stock that I'm very excited about, it's my favorite, haven't talked about it in a while, is a stock called KOF, which is Coca-Cola FEMSA. Coca-Cola FEMSA is the largest Coke bottler in the world, and it mainly operates in Latin America and the countries that are highlighted in this picture. Now, you may be asking the question, what is the difference between Coca-Cola FEMSA and Coca-Cola, the company that you know, ticker symbol KO? Well, the main difference is that Coca-Cola, the company, doesn't actually set the prices of the Coke cans in the stores. They don't even control the distribution. They don't even control the pricing. They don't control anything that goes into the store. All Coke does is every single year or every single month, you could say, they sell the syrup to the bottlers, like Coca-Cola FEMSA, like Coke Consolidated, which is another bottler in the United States. But let's talk about FEMSA. So they sell the syrup, they sell the concentrate, you could say, to Coca-Cola FEMSA. FEMSA is in charge to bottle those to mix them and then create the drinks or whatever they create. They're in charge of the marketing to bottle them and the bottles of the packaging. They're in charge of distributing them to the stores, and they are in charge of pricing into the stores. And they are the official partner or the official bottler for Coca-Cola in the region. You can't just create a company and get thousands of trucks and thousands of facilities and go to Coca-Cola and say, I'm going to be your new bottler. They have the relationship for many decades, and now the official bottler of Coca-Cola. They used to be part of Coca-Cola, and Coca-Cola was splitting them off over time to be a more efficient business. So this is a business that's going to be there forever. They're going to make money forever. They control the pricing, massive pricing power over the Coke products, which is a pretty amazing, actually, demographic for a lot of the Coke products, because a lot of the volumes there has been actually increasing. It increased 2.1% over the last 12 months as of Q1 of 2025. So they're still having some volume growth over there. And in most countries, they're having volume declines. So it's a very good place. And again, this is a monopoly. No company can come in and become the new Coke bottler. The bottlers, they are in charge of the regions. They're there right now. They're going to be there 20, 50, 100 years from now. They're going to be there forever. They control the pricing, and they pretty much control everything in the region. And they don't have to spend billions on advertising because everyone knows Coke. Everyone knows the Monster beverages, which Coke owns a piece of. Everyone knows, for example, Smart Water and a lot of the water brands that Coke has. And everyone knows all those brands. So the bottlers themselves, they don't have to spend billions on marketing. So it's a pretty efficient, pretty amazing, wide moat, just amazing business model. The company over there, I believe they have like an app where you can earn rewards and earn certain points called Juntos Plus, I think. They have 1.1 million monthly active users as of 2024. And a lot of people like to interact with the app. But my favorite part about this investment, to make it short, is you're getting the three best things about investing. You're getting a potential multiple expansion. The PE right now is at 14 times, okay? The average is 18. The company traded as high as 30 times. Now it's trading at 14 times earnings. So 14 times earnings is pretty amazing. I see a potential multiple expansion from 14 times. It's dirt cheap for a Coke bottlers. The Coke bottlers normally trade 20, 25 PE, sometimes 30 PE due to the moat of the operation. But this one is trading right now at 14 times earnings. You're also getting a dividend. The dividend right now is 4.3% with a free cash flow yield of 5.7%. So the free cash flow yield is very good, and the dividend is sustainable. So you're gonna get paid around a 4.5% dividend while you wait for Coca-Cola FEMSA to potentially play out, for the multiple to potentially go back to the mean. And you're also getting earnings per share growth of around 7.5% in 2025, up to 16.5% expected in 2026. The company has a lot of pricing power over those Coke cans and over those Coke products into the store. And the company has grown earnings per share exponentially. Sometimes there's a lot of, you could say, inflation, and they have more pricing power, like 32% earnings per share growth in 2021, 28% 2022, 11% 2023. Last year was bad at 1.5%. They raised too much prices over the last few years. This year is around 7.5% so far. Next year up to 16.5%. But I see 7 to 8% earnings per share growth on average over time. I think this is a possible assumption. So let's say 8% on average earnings per share growth. You're getting a 4.5% dividend while you wait. This is around a 12.5% annual return. And you're only paying 14 times earnings. So you have the potential of a multiple expansion back to 15 times, even back to 18, 19, 20 times, where the company was trading at back in 2024. This is an amazing business model, wide moat, and it cannot be replicated, it cannot be recreated, it cannot be disrupted by AI or anything else. And Coke, again, has a lot of water products. They have a lot of healthier products relative to Pepsi. So I like the setup over here. I think it's presenting a good opportunity. Now, the biggest risk with this investment is a lot of currency kind of fluctuations. So the company has a lot of currency exposure to the Mexican peso and the Colombian peso and a lot of different Argentinian currency, which is all over the place. But they do hedge for it most of the time, like they hedge 58% of the Argentinian currency, 59% of the Mexican one. They hedge commodities also, and they hedge currency. So they do their best to maintain a good balance. But again, a lot of the growth and a lot of numbers could sometimes be affected by FX. So you have to make sure you look at FX neutral numbers and try to look at the business from this way. But I love Coca-Cola FEMSA. I think it's presenting the best opportunity out of the two. And I like the 4.5% dividend while you wait for the stock to potentially play out. And I also like Copart very much. I think both of them have a wide moat and they're relatively undervalued, and they present a good setup relative to the overall market. I think both of them could potentially go up once the AI rally eventually comes to an end. And I think it's imminent. Now, if you find out a little bit more of what I do when I'm buying something, when I'm selling something, I share everything I do in my own group. This is the link if you're interested. But thank you very much for watching. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.